From $24 trillion in debt to a banking collapse, all in 1 year, China is plagued with a never-ending economic crisis. In Henan, 4 banks suddenly left their customers and depositors high and dry, refusing to give back their hard-earned money. With protests and detentions underway, the citizens of China are losing trust in the regime every passing moment. Can China dig itself out of this financial black hole, or is it just a lost cause? Keep your eyes peeled as we uncover the story of more than 350,000 Chinese bank account holders. A summer of collapse. Back in April 2022, a troubling situation unfolded in China's Henan and Anhui provinces. At the root of the situation were several banks in rural areas. Suddenly, they ceased providing withdrawal and transaction services to their savings account depositors. Now, keep in mind that this sudden change left around 400,000 depositors with tens of billions of yuan at stake hanging dry. The crisis originated in Zhengzhou, the provincial capital of Henan, which became the epicenter of the issue. But when did the trouble begin? The trouble began when the former vice president of Shucheng Rural Commercial Bank, Sun Jinfu, was wanted by the police for alleged serious economic crimes. As it turned out, subsequent investigations revealed that this bank had financial ties to 5 rural subsidiary banks, all of which were impacted by the incident. We have Shanghai Huamin County Bank, Yuxiao Jinxingqing Village Bank, New Oriental Country Bank of Kaifeng, Jixing Wanhui Community Bank in Henan, and Guqin Xinhui Village Bank in Anhui on this list. A depositor named Du told CNN that he entrusted his entire family savings, amounting to approximately 5 million yuan or $726,000, to one of the banks involved. Du shared his distressing situation with CNN, stating, "I am now dependent on the charity of others or receiving donations. If I am unable to access my money soon, my children and I will have no choice but to live on the streets without a place to call home." And this testimony is just a glimpse of the extremity of the situation. But even in such a repressive regime, and in the middle of COVID-19 lockdown measures, the affected people did not hold down their voices. Code Red. After months of waiting for their savings to return, hundreds of frustrated depositors gathered outside the China Banking Regulatory Commission in Zhengzhou, the capital of Henan province. Armed with signs that read, "Return my savings," these individuals were not willing to wait any longer. However, as CCP always has a trick up its sleeve to repress the protest, the regime struck on these protesters. So then came along the Red Code scandal, which is what brought national attention to the bank crisis. After the bank run of Henan, over 1,000 rural bank depositors suddenly found their COVID-19 health codes turning red for no apparent reason. Normally, a red code indicates a high risk of infection, resulting in individuals being prohibited from entering public spaces. This unexpected change in health codes triggered widespread anger among the masses as expected. It fueled concerns about bureaucratic arbitrariness and raised suspicions of anti-COVID measures being exploited to enhance the political control of the CCP. Sounds diabolical, right? Well, the public backlash against this incident was huge and even caught the attention of conservative figures like Hu Xixin, the former chief editor of the party-owned Global Times. Faced with a tidal wave of criticism, the CCP attempted a familiar scheme to quiet the public's anger. As predicted, they attributed the scandal to the actions of a few local officials who had violated party disciplines and state regulations. Consequently, these officials were subjected to disciplinary measures, and the CCP publicly declared that it does not tolerate changing the health code for reasons other than pandemic control. However, none of these so-called officials were punished, and the innocent victims bore the brunt of police brutality. But is there a deeper reason for this crisis? Initiation of the crisis. It is a well-known fact that China's middle class has a strong inclination toward real estate investments. In fact, the real estate sector contributes a significant 24% of the country's gross domestic product, which makes it a crucial part of the economy. However, this rapid growth in the real estate market also led to a surge in debt since 1998. Recognizing the potential risks associated with unchecked debt, the Chinese government took action in 2020 by implementing a policy known as the 3 Red Lines. This policy aims to regulate and manage loans in the real estate sector. In 2021, prominent developers like the China Evergrande Group, one of China's largest property developers, began defaulting on interest payments. And then, a downturn in the entire industry was triggered. By June 2022, the situation had worsened considerably. Sales and home prices declined, construction activity plummeted, property loan growth slowed, and consumer confidence weakened. Now, China's financial system is currently under massive stress. A few of the factors for this stress include poor capital turnover, liquidity stress, and the combined impact of the domestic zero-COVID policy. Chinese banks have become more interconnected with the global financial system, but that is not news for celebration. All it means is that the risk of spillover effects that could negatively impact global financial stability has been intensified. Yet, the real question remains, what did the investigation into the matter of the bank run reveal? Corruption, embezzlement, and the mortgage crisis. Investigations into the matter revealed that a private firm called Henan Group had stakes in all the four banks. Turns out, it staged the embezzlement of funds through fabricated loans in collaboration between internal and external parties. As a result, the affected depositors found their accounts frozen, which made them unable to withdraw their money. During the investigation of the banking crisis in Henan, regulators uncovered a decade-long trail of fraud and identified corruption within the financial watchdogs themselves. This raised concerns about depositors' involvement in the misconduct and whether they would be able to recover their funds. Additionally, the government faced the broader challenge of restoring trust in the entire banking system. To address these issues, Beijing dispatched an experienced regulator, Liu Rong, to resolve the mess in Henan. Nevertheless, he encountered a common hurdle: tensions between local and central governments when dealing with financial crises. Adding to the complexity of the situation, Henan province is also grappling with a mortgage crisis. Homebuyers have begun boycotting loan payments due to difficulties faced by developers in completing and delivering unfinished housing projects. This increasing trend of mortgage boycotts has raised concerns among authorities, as they fear more homebuyers will follow suit. Lenders now find themselves dealing with cash-strapped developers as well as defaults from homebuyers and suppliers. The refusal to repay loans has resulted in losses for banks, meaning that China's property crisis may spill over into the financial system. According to estimates by Jefferies Financial Group Inc., if all the stalled projects were to default, it could lead to an influx of 388 billion RMB, which amounts to $58 billion in non-performing loans. While a group of 15 Chinese banks, including China's largest mortgage lender, China Construction Bank Corp., has stated that the risks are manageable and their exposure to delayed projects is limited, the reality couldn't be further from this. Some depositors paid, thousands not. Over the past year, the majority of depositors received their money back. However, there are still several thousand individuals who have yet to receive any repayment. Depositors are being treated like criminals just for demanding their hard-earned money back. This lack of transparency has raised concerns among experts who believe that similar crises could be unfolding in other provinces. As China faces a longer-term structural slowdown, small banks in various regions might also encounter financial difficulties. According to Frank Shi, the professor at the University of South Carolina, Aiken, the situation in China's small banking sector is just the tip of the iceberg. He estimates that at least 1/3 or 1/4 of the small banks in China are facing troubles. These smaller banks, which hold about a quarter of the Chinese banking industry's total assets, often have opaque ownership and governance structures, which makes them more susceptible to corruption. In March 2023, Beijing announced a comprehensive overhaul of China's financial and banking oversight and regulation. This newly formed regulatory bureau is expected to become a powerful entity responsible for maintaining financial stability and protecting consumers. Now, the People's Bank of China can focus on traditional monetary policies. Additionally, local central bank branches are supposed to be streamlined, and regional authorities will surrender power to central regulators in local financial affairs. The success of these reforms will determine whether China can effectively manage future banking crises and ensure the stability of its financial system. Do you think the depositors will receive compensation for their loss? Drop a comment below to let us know. And don't forget to subscribe to stay updated.